Hello and welcome to Week 6, Like-Kind Exchanges and Tax on Disposition of Property. By the end of this lesson, students should be able to identify the requirements needed to make a like-kind exchange, describe qualifying like-kind exchanges, describe liabilities of like-kind exchanges, describe the concept of boot, and understand the complexities of related party transactions. In past lessons, we've learned that when a taxpayer relinquishes property, typically gain or loss must be recognized. However, Section 1031 of the Tax Code allows that in certain circumstances, gain or loss can be deferred on a transaction. Now, there are some very specific, very procedural rules that must be followed, and if you fail to follow any of these very specific rules, then you'll spoil your ability to defer your gain under the like-kind exchange rules. So if your client is considering a like-kind exchange, it's very important that you have competent tax counsel who understands the rules in and out and can make sure that your client follows those rules. There are a few basic rules of like-kind exchanges. The two of the three major rules deal with timing. So a like-kind exchange does not need to be simultaneous. You can relinquish your own old property without knowing how you're going to replace it. You just must identify that new replacement property within 45 days. Then, within 180 days of relinquishing the old property, you must actually take possession of the new property. So this happens most often in real estate. You'll identify real estate, but you can't buy it that day. You have to schedule the closing, and it typically takes a month or longer. But you want to make sure that your closing isn't scheduled for the 180th day, because if something happens and that closing is pushed back, there is no extension on the 180-day rule. You want to make sure that you are well within that 180-day limit so your client can take advantage of the gain deferral. And the final thing I'll say is just to emphasize the 180 days is from the date of relinquishing property. It's not an additional 180 days after the 45 days. So you don't have to do a simultaneous exchange, but in 180 days of relinquishing property, the new property must be in your possession. Now, not all property qualifies for like-kind exchange. Inventory, securities, evidence of indebtedness, partnership interests, certificates of trust, and agreements providing the right to recover assets from another. All of these assets are assets that do not qualify for like-kind exchange treatment. And so that's why you've never heard of someone like-kind exchanging Microsoft stock for Apple stock. It's because it's simply not allowed. Most of the time in a like-kind exchange, the fair market value of the like-kind property given up is not going to be equal to the fair market value of the like-kind property received. When that happens, typically there's some non-like-kind property that's included on one side or the other to make the transaction economically equal. This non-like-kind property is called boot. Boot has implications both for whether all of my gain is going to be tax deferred, and boot also has implications on the basis of the new property. So if I am giving boot, so I give my like-kind property and some non-like-kind property and receive more valuable property in exchange, then there is no impact on my ability to defer my gain. So I can defer 100% of my gain on the like-kind conversion, the like-kind exchange. However, if I'm receiving boot, so I am receiving like-kind property that is less valuable than the property that I'm giving up, and therefore I'm getting non-like-kind property in addition, I'm receiving it, then that's going to trigger some gain. And the gain that I recognize is the lesser of the gain on the entire transaction or the amount of the boot received. So boot received, potential recognition for gain. Boot given, no effect on my ability to defer gain. There are two ways to calculate the basis of your like-kind property acquired. There are two formulas. Each of them will get you to the same answer. So if you are doing a homework problem or a quiz question or a final exam question, or even if you're working with clients in real life, I always suggest that you calculate the basis using both formulas just to make sure that you're getting the right answer and you haven't made an error in one place in your formulas. So the first way to calculate the basis of your newly acquired like-kind property is to start with the adjusted basis of the property given up. Then you add boot given, you subtract your boot received or your gain recognized, and that will be the adjusted basis of your new property. On the flip side, you can start with the fair market value of your property received, you can subtract your deferred gain, you can add your deferred loss, and that should get you to the same number, which is the basis of your property acquired. Just like the basis of your newly acquired like-kind property is a modified carryover basis, the holding period for your new property also carries over. So if your old property was held for more than a year and you receive your new like-kind property, on day one, your newly acquired like-kind property is still considered to be a long-term holding period. Conversely, if you had held the property for less than a year, then you're still in that short-term period when you acquire your new property, but you get that extra month or that extra day or however long that old asset was held, that gets tacked onto your holding period for your new asset. Now, in contrast to the like-kind property getting that carryover holding period, if you do receive boot in a transaction, the boot holding period starts the day you receive the boot. So it's not like-kind, and the holding period begins when you receive it. Related party like-kind exchanges are allowed. You are still able to defer your gain. However, if either party disposes of property within 2 years of the exchange, then the gain is recognized. Now, this is different from an arm's length transaction, because if I enter into a like-kind exchange with a non-related party, and the next day or the next month, this non-related person disposes of my old property, that has no effect on me because I still have my newly acquired like-kind property, and as long as I hold my new property, I will not have to recognize any gain. However, if that person was related to me and that person disposed of the property within 2 years, even though I'm still holding on to my like-kind property, I would be required to recognize the gain simply because my like-kind counterpart got rid of that property. So again, this is to eliminate the abuse, the tax manipulation that's more likely to happen with people who are related to you, and that's why the rules are in place. However, if the counterparty passes away or that old property is involved in an involuntary conversion, then these rules do not apply. So let's talk a little bit about involuntary conversions. As the name suggests, it's when you give up your property, not of your own accord. It wasn't your decision to lose the property. Typically, this will happen in a natural disaster. So it would be a flood, a fire, tornado, hurricane, those types of things. When that happens, you have an opportunity similar to the Section 1031 exchanges to defer any gain on that involuntary conversion of property. The rules are very similar to 1031, but they're less restrictive on the type of property that you can use as a replacement property. Basically, the replacement property must have the same functional use, so it doesn't have to be from the same very narrow class band, it's just the same functional use. In addition, you have a little bit more time to identify and secure that property. Typically, the new property must be in place and in your possession within 2 years. If it's part of a presidentially declared disaster area, quite often that time period is lengthened to 3 years or more. And this usually happens because if you've ever worked with clients who have been in a natural disaster, especially one that's a presidentially declared disaster, it's a very large scale. Building materials are in short supply, and as much as people want to rebuild their homes and get into their homes, sometimes the market just won't allow them to do that, even within the 180-day period. And so that's why this involuntary conversion period is extended a little bit longer to help people get into their homes in a timely manner and not lose that tax benefit simply because the market pressures won't allow them to get in as quickly as they would like. The last thing we'll touch on are Section 1035 exchanges, which are like-kind exchanges involving insurance products or annuities. There are a few exceptions, but generally you can exchange one type of life insurance policy for another or one type of annuity for another, but you can't cross-exchange life insurance for annuities. And the idea behind this is if a client or a taxpayer has an insurance policy or an annuity that no longer suits their needs, if they would like to find another type of similar product, again, like-kind product, then the IRS will not penalize them and make them recognize gain and pay taxes on switching from one type of product to another. So this can be helpful, especially if you have clients who come to you with old policies, old annuities, and as part of your analysis you find that another type of insurance product or another type of annuity would be better suited for them. This allows you to make that change without triggering tax consequences. So in summary, today we've learned about the special tax treatment of like-kind exchanges, involuntary conversions, and Section 1035 exchanges of insurance products. When the precise rules are followed, the gain can be deferred, and I hope you'll agree that these are excellent tools to have in your tax planning toolkit.